Welcome to the Smart Property Investment Show. In this episode, we're joined by two experts to discuss the big issue of the moment, negative gearing. We also consider doomsday predictions that markets are going to fall between 30 and 50%. This and much more in this episode of the Smart Property Investment Show. Welcome everyone to the show. It's great to have you with us today. A couple of things that we're going to discuss, two burning issues that's happening right now. One of them running on the backs of a report on 60 Minutes this Sunday around market predictions of a drop between 30 and 50%. They've got some American bloke out who's telling us that the sky is going to fall in. We also have a look at negative gearing. I'm joined by two guys that I know quite well. Ben Kingsley, who is the chairman of the Property Investment Professionals Australia, which is a peak body for the property investment industry. And I've also got Steve Waters, who's a director at the Right Property Group. He's a buyer's agent. Ben is a very accomplished buyer's agent and also a property investment advisor himself. Steve.
No worries, thank you.
And Ben, thanks for joining us.
Thanks for having me on.
Ben also has a very good property podcast called The Property Couch, which is a weekly podcast which comes out on what days?
Normally Thursday afternoons with Bryce Holdaway. Yeah.
Okay. I listen to it regularly. It's a great podcast.
Thank you.
Ben and Bryce go through a lot of scenarios, so a lot of people dial in asking questions about different stuff to do with property, and these guys are very well geared to answer them as qualified property investors.
That's right.
Property advisors.
Yeah. Advisors, investors. Well, we do it all. I mean, we're just like you. We're active in the space, but we also, it's our industry. So we're passionate about making sure people are making smart decisions when it comes to property investing.
That's what it's all about. So there's two things I want to have a chat about today. One is negative gearing, and you're either under a rock or you never open up a magazine or go to a website. That it is all the rage at the moment. Everyone's chatting about it. So I really wanted to get some insights and some clarity on what's going on in that space. And I also want to have a chat about the potential for Australia's property prices to drop between 30 and 50%.
There's your headline right there.
It is. There's a doomsday merchant in Australia at the moment from America, a bloke called Jonathan Tepper. And if anyone watched 60 Minutes on Sunday, he's forecasting a massive drop in property. So we'll pick that conversation up a little bit later on. So let's start with negative gearing, guys. Both of these guys are well positioned to discuss this from two different angles. I think I'm going to be looking to them for insights around what is the impact for your average property investor. Before we get started, I'm going to run through some stats which just to set the scene a little bit. So $6.4 trillion, that's the value of Australian residential real estate, of which 1.5 trillion of that is mortgaged. Now, when you look at that in context of other asset classes, Aussie superannuation is $1.9 trillion, Aussie listed stocks is $1.6 trillion, and Aussie commercial real estate is $0.7 trillion. That gives you a lot of context into the size and the scope of Aussie real estate. Some other stats which are connected with that, 51% of Aussies, their wealth is in residential property, and 55% of bank assets are underpinned by property. That's pretty good summation of how it all works, Ben.
It is. It's a really good summary, and thanks to CoreLogic RP Data for those stats. What's important about that is it just goes to show that if you're going to make policy changes in this space, you've got to understand how it could potentially distort the market, and I think that's probably what we want to have a chat about today.
Absolutely. So, Ben,
yeah,
what is negative gearing?
Negative gearing is not a strategy. Let's make sure everyone understands. It's not an investment strategy. It's a byproduct of investing in anything. So if you go into business and you have costs in that business, you can claim those costs as a tax deduction. Property is no different. So Australians who invest in residential property are in the business of providing residential accommodation for other Australians. So in the process, we might borrow money to do that. There might be a cost associated with that. So we have the ability to cover those costs. Now, if our income, the rent that we receive, is lower than operating that business, i.e. running the property, then we can claim that loss against our income, our personal income in that tax year.
Okay.
That's simple.
All right. So what's happening at the moment? What's all this noise around the marketplace that the government is going to get rid of these incentives?
Well, the government has a problem. They've got two problems, really. Their big one is spending, but their second problem is revenue, to provide the services that they want to provide across the community and the promises they've made, they've got to raise this revenue. So unfortunately, they don't have the appetite to have a full hubs and spokes look at the whole system, the tax system, which is what they needed to do. So because it's politically sensitive, they're now starting to pick on, where can they raise revenues that's not too politically damaging for them. And one of those is obviously negative gearing. So we've seen the Labor Party come out with a policy position, which we think is short-sighted and narrow-viewed. And you might say I have a bias because I'm in the industry, but I also, believe that this could have the potential to affect mum and dad owners, not just property investors, because of the distortion that's going on. The Liberals, on the other hand, they also think that there's probably a bit of unfairness to the system in terms of, high net worth people, high income earners get a better advantage than lower income earners. So they're probably looking at it from a different angle, as opposed to the Labor Party who've come out and said they'll change it, they'll tweak it to try and just do it on new property, and also the capital gains events. They'll reduce the 50% concession after holding the property for 12 months down to 25%.
Okay, so there's been some papers put out recently, and obviously governments and respective think tanks, they love to put out papers, positioning pieces. Now, one in particular has been bandied around recently from the Labor government, which has essentially tried to paint the picture of the current state of the market. And Ben, what's it called? It's
a distribution modelling for proposed negative gearing and capital gains tax reform. It's a research piece by Ben Phillips from the Australian University in Canberra there for social research and methods. So it's okay. That's
a tongue twister. I imagine
it is.
A couple of blokes down the pub are probably discussing it right now. But some of the stuff from that and running on some of the numbers we talked about before, 1.8 million property investors in Australia, this report said, thereabouts,
yep.
Of which 1.2 million of them getting some sort of negative gearing benefits.
Yeah, so the data's back to the 2011-2012 tax year. So first of all, I'm sort of thinking, well, that's a bit old. And interest rates at the time were around probably 6%. Now, when you've got interest rates 6.5%, you've potentially got a greater cost. And now those interest rates are down in, say, mid-fours to late fours. And so I suspect if they did the numbers again on the current level of people who are negatively geared in property, I think you'll see an improvement where people are either neutrally geared or they're actually positively geared. The other thing that the paper doesn't address is the percentage of depreciation that may be occurred. So for the listeners out there, depreciation is an add back. So we can effectively, as the asset deteriorates in value, it's in our tax system, just like gearing is in our tax system, or costs to run a business is tax deductible. What happens with depreciation is the value of the property deteriorates over time, so we can write off that value. And it's fair enough because that's wear and tear, so we've got to be able to replenish that over time. So I'm really keen to get new data from the ATO so we can have a look at the true numbers. So yeah, you might say I have a bias, but I want to make informed decisions based on accurate data and not just 2% sample of a data set that was ripped out of the ATO back in 2011-2012 data tax year. So it's really important to understand that the models that are being built here are based on the performance of a market that the government and the opposition are basically saying we're going to distort. So how can you then make claims that the market's going to perform consistently along that on that track if you're going to basically play with the actual open market? Doesn't make sense.
Doesn't. So this is not a beat up of the debate that's going on around negative gearing right now. I think a sensible open debate at both sides of government is important.
Yeah, we want debate.
We want the facts. We want the facts. This is for the longevity of the Australian property market. As we spoke beforehand, 51% of all Aussies' wealth is tied up in residential real estate. So this affects every single Australian in some way or another. They're either own property or they're renting property. So I'm a property investor. So to me, I care about how this is going to impact me today. I think there's a lot of misconception in the marketplace that a lot of people invest in property for a tax strategy. You hear it all the time, Steve, you hear it all the time. People think that property investment is a way to minimise their tax they pay. Now, look, that's an outcome of investing in property, but your strategy should be around either the property going up in value or getting a good cash flow or both, and both is what I look for. Now, Steve, you deal with investors every single day. Some of them are highly educated, like myself.
For sure.
You are highly educated. Let's be honest, you are very educated.
I just ask a lot of questions.
Don't say you're not educated.
You ask the right questions.
Yeah, I ask the right questions. But whereas other people are keen and they're fired up and they want to get into property because they want to create wealth or they want to do this, that, and the other. Now, when you chat to investors, so say your first point of contact with an investor who goes, Steve, I want to be a property millionaire and
Trillionaire.
Yeah. How many Aussie investors actually know about negative gearing, and what's the sort of misconceptions that Australians property investors have around? I'm talking about new investors before they get sucked into the cycle and understand it.
Look, to be honest with you, if I was to take a sample of all our clients, I'd say less than 2% of people come to us saying, I'm really doing this to minimise my tax.
Oh, that's good.
It just doesn't happen. I think investors in today's age are far more educated than what they were perhaps last property cycle, including yourself. And I would, like, my whole problem with this is that it's all about modelling, and you and I speak a lot about ground truth and the effects of ground truth versus modelling and statistically speaking. Because the government is a government, everything is, it's all about modelling. There's no ground truth to it. And I don't think they've really thought through the ramifications of what's going to happen in the very near future if this policy was to actually take place. And in a sick kind of way, and we were talking about this before, I'm not too fussed whether they do or don't, because I think it'll create opportunity.
So this goes back to one of the fundamentals of investing, that one of the tenets that I base myself on. I concentrate on the things that I can control.
Yeah.
And I'm aware of the stuff that I can't control, but I don't overly concern myself with it. So interest rates are going to go up and down. I can't really do much about that, but I can do a lot about how I position my portfolio and then my ability to service my portfolio as a result of that. So I think investors need to be aware of what's happening and they need to understand the consequences of stuff happening, but they should be preparing for eventualities that negative gearing does get canned or gets changed in some sort of way.
Well, it's part of your worst case scenario, whether they change tax law. It's one of the things we talk about. There's no use relying upon depreciation or negative gearing, I should say, because at the end of the day, you're actually wanting your portfolio to be producing you cash flow. And if you get a little bit of negative gearing in the early stages of your portfolio, well, it's just a byproduct. It's a bonus.
So what happens if I invest in property and let's say a pretty typical investment property that I buy might be between $200,000 and $300,000. I finance it at 80% LVR. Traditionally, how long will it take that property, maybe it's one for you, Ben, to become positively geared?
I've done the models.
How long is it negatively geared for?
Well, it depends on the income. It depends on the growth, the story. So there's a lot of variables that come into that. But actually, what I might do for the audience there is I'll send you some models. Okay. So I can show those, and they can get on the website and have a look at those as well. So it usually, depending on cost of funds, is around that sort of 8 to 9 to say 12, 13 years, depending on the depreciation. So if you take depreciation out, it can usually be around 11 or 12 years if you're chasing a growth asset. If you're chasing a yield asset, it could be instantaneous. Like, you can find positively geared properties out there today. You know, they're not easy to find. They're in some areas and remote communities and other parts. And that's because the actual audience who's looking to buy that property, or the people who are living in that area, are saying, I choose to rent here as opposed to buy, because the asset might stack up, or I'm only here for a short period of time for work commitments and the work's seasonal, so I'm going to move on. So it really does depend on those things. And you hear us always talk about, we invest for two things: capital growth or income, rental yield. Now, you can get what we call high growth assets. You can get high yielding assets.
High growth, you mean that the property's going up in value?
Yeah, that's right. Yeah, they're the big ones. So no different than when you're investing in equities. Okay, you normally see someone talk to you about equities and they're going to say, right, what do we want? Do we want a growth strategy where we're looking for the share price to move, or do we want a Telstra, i.e. we want a regular distribution and a regular income, and that's where they'll go for a yield play. And in the middle, there's the marketplace, which is balanced, so you get a bit of growth and a bit of that. And that's the sort of stuff that generalising, and we're being very generalistic here, is what we're talking about. We're basically saying that you can chase growth assets, you can chase yield assets, or you can chase a mix of the two. Now, timing the market affects that. If you do it really well and you find a pocket of the marketplace where you can jump in and you think that there's good yield and there's potential for quick capital growth, well, that's the skill of the research and the professionals that you potentially engage, or the own research you do yourself.
Okay, so let's run through some scenarios.
Yep.
Okay, I'm going to quickly hit you up with some numbers, because you know these better than I do. We said there's about 1.8 million property investors in Australia.
Yeah, it's probably up to about 2 million.
About 2 million.
Yeah,
okay, because these are old numbers that we're working off the Gobbledygook report. That I can't remember the name of it. Okay, 2 million property investors. How many of those property investors own more than one property, one investment property?
So go back into the 2011 data. From what I recall, 73% own one property.
Okay.
And then we get up to, I think, looking at, these are the numbers I should know straight off the top of the head, but...
So should I, that's why I asked you to say. Steve, what are they?
I can't hear you.
I think it's, so it's almost like, what is it? I'm just trying to recall the numbers. It's probably in my book, actually. They're probably in there. Anyway.
By the way, try and get a plug for the Armchair Guides of Property Investing, How to Retire on $2,000 a week by Ben Kingsley and Bryce Holdaway. By the way, where do I find this book, Ben?
At all good bookstops, or you can go to the website and just /book. So,
okay. All right, cool. For our listeners, I'll take a picture of it and I'll stick it on my Twitter, at Philip Tarrant. You can go check it out and find it. I've just got a copy today, so I look forward to reading it.
Yeah, so I think the bottom line is... as you get higher, less and less people. So it's something like 1% own more than 4 properties.
Okay.
As an example. And then I think for 2% it's sort of around that sort of, 1 in every 100 Australians own a property.
Yeah.
And then from that it's sort of like 9 in something like that.
So this sort of getting rid of negative gearing, is this a pot shot at the rich, or is it a pot shot of every Australian who's trying to create wealth in property?
I like to think it's the second. Look, it disappoints me that, and I know government have got to raise revenue. They've got to provide services and amenity and health and school and education, and I'm big on those things.
Good. Yeah.
Really big. I mean, that's what a government's in place to do. But what disappoints me, I suppose, in the same conversation is I'm not interested. I want people to be self-determining, and part of why we do what we do professionally is to change people's lives. We are very fortunate and we're empowered to look after people's circumstances, and they entrust us to help them build wealth. And we have a bias towards bricks and mortar. That's how we go about it. And so, as part of that process, as I get wealthier, I do expect to pay more tax. But what I don't expect is, what's happening in the Australian economy? Bricks and mortar's gone really well. Look at everyone's net worth. It's 51% of their overall wealth. Well, here's an easy target. Let's just go and pick on. They've made all this money, and the government hasn't got a fair clip of the ticket. So that's what disappoints me. And I encourage all people to invest, to get better money management skills, to do their homework, and have a go. But policies like this are just sort of saying, well, where do I go? Because if I look at the equity markets, they're down 20% since last year. This time last year, the markets are off 20%. So if you're going to take away some incentives for me to provide accommodation for fellow Australians, and where do I get to invest? I'm going to put the money in a term deposit, and then 2.5%, 3%.
If you're lucky.
If you're lucky, So what choices do I have? And so you're basically funneling me into an investment system that's highly volatile, that I don't necessarily like, whereas I like bricks and mortar. So why can't I have that experience? And then you're saying, well, you still can, because we're only going to tax people who buy, we're going to give the incentives to people who buy new property. Well, I have a fundamental problem with that. And so does the Australian investor. 93% of all investors have been buying existing property. And they're just expecting us all to say, oh, yeah, we'll play this game. And now we're going to move across and buy high density and medium density apartments, or off the plan, or house and land packages, which the Australian marketplace says, you know what, we don't really like that stuff. So, and there's no secondary market. So I just don't think they've thought the policy through. And it comes back to the point. If you're going to distort a market like that, you're going to kill off, and you're going to have potentially scenarios, and I call it, a two-tier cities. You're going to have areas in the outer suburbs where the value of property is going to absolutely flop, because there will be this potential for oversupply. And when the oversupply is there, you can't get a renter then. So if I'm not making any capital growth and I'm not getting a renter, I'm going to get out of it. But who's going to buy that? Well, guess what? Most Australians don't necessarily want to live on the fringe of town and have an hour and 20 commute into their employment area. They want to live inner or middle areas. Well, that existing stock will still be very popular, so that won't affect the values of that. But the high rise and the medium density stuff, who's going to buy that in a secondary market?
And then you'll have a carried forward loss, which defeats the purpose.
Correct.
Of the revenue gain, I suppose, or the revenue grab. I think at the end of the day, will this happen is I suppose is open for debate. It's an obvious revenue grab. and I think we just got to deal with it. At the end, what we think, what we talk about, is not really going to change the policy.
But it's our job as board members, isn't it, Steve?
Absolutely, to make people aware of the ramifications.
Yeah. And how would those Australians who aren't even remotely interested in residential property, whose house prices down the street is going to be affected by tanking
That's
market?
my point. That's my point. We talk about the government having not thought this through.
The opposition.
Let's be honest. To be corrected. I actually think this is going to affect everybody, even the non-investors. You say anyone that owns a property, an owner-occupied property, they're going to see their net worth deteriorate. They're going to see the price or the value of their property deteriorate, and they're really going to be. Labor will really be affecting those that they're trying to protect.
It's their heartland.
It's their heartland. That's correct.
Because the reality is that the land in a city is going to then become so valuable from a development point of view, even if it's knocking one house down and building two duplex.
Yeah,
that's going to be worth a lot more. So all of a sudden, these 4-bedroom houses on these parcels of 600 square metres of land are going to be worth a fortune.
The zoning will change to accommodate accordingly. Yeah,
the rich people who live in those areas are going to get another kick. Positive kick up, and then the middle and outer Australia are going to get suffocated with oversupply or no interest in their property and no momentum for the values to keep growing. Well, and then that affects state government revenues because stamp duty revenues will soften, and if land values,
stamp duty
it's a byproduct.
So people aren't buying stuff.
Well, people will be too scared to do that. Yeah. So the volume of transactions will decline, and therefore the state government revenue in terms of stamp duty will deteriorate. But I think, for me, and we've done our own, to use the word, modelling on this, I suppose, and we talk about the net value of the average Australian who owns their own house deteriorating, and we think that Australia's economy at this point in time is really driven by consumer confidence, of which a big part of it happens to be property. You take that away from the economy, we haven't got a hell of a lot going for us, maybe a lower dollar with exports and what have you, but it's going to affect the bottom line in terms of revenue, but more importantly, or just as importantly, it's going to affect between people's ears, and at the end of the day, consumer confidence drives any market.
Sentiment is really, really important.
Very important.
You're seeing sentiment in the stock market, volatility, concern. You have this flight to safety. That most average or inexperienced investors take their money out when it bottoms out. And so they get in at the top and then take their losses. So we've got to keep educating people, and this is why, coming back to that point, we want to make sure that this is not just about negative gearing in investment properties. This is about everyday Australians' house prices and the 51% of their wealth caught up in that house, and distorting a marketplace where you're influencing an open marketplace where you've got 30% of the market affected. You really don't know what's going to happen. But we do on the ground because we get to see it and we know what the buyers want. And the buyers vote with their feet. Emotional buyers, owner-occupiers set the price, and investors, we take the price. That's pretty clear. And if we go into marketplace where it's frenzy investors, well, that's mining towns. And that's where we get our pants pulled down, because there's high volatility in those marketplaces because it doesn't pass the lifestyle test. So all of a sudden you're going to have the wealthier getting wealthier because their land's going to be worth a lot more in a city, and then those outer city suburbs are going to tank, and they're going to tank poorly, and then the councils are going to have less revenue because their land values have gone down, and then land tax is gone, so councils are going to have to raise. So is this a net gain decision? We're talking about federal government because land tax and state government revenues are stamp duties are state government revenue. So we've got a real problem there. So for me, it's like, okay, well, are you robbing Peter to pay Paul? Is this going to be a net positive revenue gain earner, or is it just going to distort the marketplace to a point where we're not going to return from it, and we're going to see another backflip in regards to policy changes like we saw when negative gearing was cut out in 85 to 87 or there?
I suppose some people would like to bet that would be the case.
Yeah.
And I think for the investor, or for the opportunistic investor, that if this policy does go through and Labor get it into government, I think there might be some real opportunities in the short to medium term for the savvy investor. There'll be some areas, no doubt, that I think will kick on. Those areas that are close to the CBDs or close to the metropolitan areas, say half an hour out, that are providing good yields as it stands today, it may drive investors to that with the better returns.
How do we move forward with this? Obviously, I'm not going to change what the government does, but as a collective voice, as an investor, we've all got Some say
we vote.
What move forward? We
Absolutely,
vote.
we vote. You know, like I remember driving down the road and you saw the I fish and I vote. I mean, that's the talk. It will take a collective group of people who see the sensibility of this, and even the children of the parents who might be there voting for the first time, and they're thinking this might help them from an affordability point of view. If you want to live out wide, it's going to help you, but if you want to live closer in, it's going to make no effect at all. So coming back to that point, what I would love to see is the data. Okay, so let's get all the data out on the table. One of the big models I would love to build is, say, a journey of an investor from their tax position for the last 10 to 15 years. So whereby they have a deferred offset saving at the start, because I don't like the wording that's being used about a subsidy. It's not a subsidy, okay? It's deferring that loss because you're holding that property for the long term and you're going to make a gain. So let's measure, how many people have held properties for 10 or 15 years and what has been that net revenue gain to government. Because that's what we're talking about here. If this is a revenue story, well, that property's turned positively geared, so now I'm starting to pay tax on that. And then if I ever sell that property, you're also going to get the 50% that's going to be taxable at my income of that year. So for me, that's what I would like to see us look at the models. And so where we have this, these headlines coming out of government that, it costs the Australian public $11 billion in subsidies, they're not subsidies. I'm in the business of investing in property and I've got an offset to start with. It's helping me get on my feet to create that type of accommodation that's available for others. And at the end of the day, we've seen how government ran social housing and how they, over the last 25, 30 years, have got out of it because they're not very efficient at it. But I can tell you, mum and dad investors are very efficient at running good accommodation for new Australians, so new arrivals, existing Australians who want to live in that location, to provide that accommodation for them. So I think socially, the social fabric is also something to consider in this conversation as well.
It's important. So look, we can talk about this all day, but we need to move on very quickly to the last point. But what I'd like our listeners to do, this is about education. You need to understand how negative gearing at the moment is influencing your portfolio, how it might change the look of your portfolio over time and your position, and how moving forward it plays into your investment strategy. So for a lot of people, it might change the way they invest or invest at all. So I'm going to put this up on the website, but the Property Investment Professionals Australia last year, when this debate sort of started raging, they put out a bit of a piece which was to inform Australian investors around why negative gearing is not a bad thing. And there's 6 points in. I'll just read out the sort of headline. Go to the website, smartpropertyinvestment.com.au, where we'll put this. Check it out, have a look, and start asking questions to your property investment advisors, your mortgage brokers, everyone, your accountant, anyone that sits on your A team, to find out about negative gearing, find out how it's influencing you right now and how it might impact you. So those 6 points are, this is why negative gearing is not a bad thing. So number one, surging house prices in some places is due to a shortage of supply, not negative gearing. Number two, negative gearing is widely used by ordinary Australians, not just the rich. Number three, negative gearing supports ordinary Australians to provide for their retirement and support the provision of housing. Number four, removing negative gearing would hurt the economy. Number five, removing negative gearing would hurt young first-time buyers very hard. And number six, negatively geared property usually becomes positively geared. And we spoke about that a couple of times in this podcast. So it's a longevity thing. So check it out, have a look, form your own opinions and ask questions. Moving right along. Doomsday Merchants, 60 Minutes on Sunday night. I really like the piece they did after this segment on the new F-35 strike fighter. I think that's a pretty cool set of kit. But they did a piece also. A bloke called Jonathan Tepper was bought out by some sort of funds house to look at the Australian market. And this is the guy who allegedly predicted the global financial crisis. This guy reckons that Australian property is overvalued by 30 to 50%. And the basis of that is that compared to the rest of the world, the value of property or people's property compared to how much they earn is way out of proportion. We hear this all the time. They love rolling out American experts who to come out here and tell us how bad things are. Guys,
Why is it that we have to go to America to get
Yeah,
an
I'm a little
expert?
offended with that. Don't we have smart enough people
No.
here?
Well, because obviously no one's willing to make that stupid
I know,
statement on national television.
Well, it's good to see our economists. I've read some stuff around this over the last couple of days, and Shane Oliver at AMP and some of the other guys have come back saying, you know what, could it happen? Yeah, but is it going to? Let's look at the fundamentals of Australian property. The fact that prices keep going up, and whether that's because of negative gearing, I don't know. But but the fundamentals of Australian property is sound. What are they, Ben?
Oh, look, they're simple, and let's put it into context to America. Let's compare it. So the last time I looked, and this was a few years back now, but the minimum wage in America was around $8. Call it round numbers, okay? Minimum and medium house prices in America, anything between sort of 300, 350,000. So relative to income, hourly rate. Minimum wage in Australia, I think now pushes about $18, right, for entry level. So that's $18 an hour. And median house price in Australia, about 500 to say 600,000 or 550 round terms, depending on which research house you're looking at. So does that not speak to you about, so we're double their minimum wage, and our property prices are around double. So it's all relative to income. So for me, the fundamentals around property are obviously employment, that income story, access to liquidity or cash to borrow money, and then generally speaking, people want to live where they want to live. So owner-occupiers drive that story, and that's why we see property prices. And I'll bring it back to negative gearing. Around the world, there are expensive properties, and around the world, they don't have negative gearing. But as you move out and out of those suburbs, it gets cheaper and cheaper because it's proximity to city, proximity to workplaces, it's the demographics of the area, and because I buy based on human interest and human behaviour, because property is an emotional asset. It signifies who I am. It represents what I stand for, both consciously and subconsciously.
And a homeowner will always justify that little bit more extra money to purchase the property. I think the major difference between us and them, so to speak, is that I think that the very fabric of our banking system is a lot stronger than theirs.
Well, let's look at this. 55% of bank assets are underpinned by property. Mm-hmm. This particular report done by 60 Minutes, they used a great example of how this is happening right now in Australia, in Moranbah, where some poor investors invested, they only bought 7 or 8 properties, and they're millions of dollars in debt, and now those properties aren't worth anything.
Google Moranbah. Go and have a look at it from a satellite map, and you will see it as a speck in the desert. I mean, anyone who thinks that that's sensible investing and putting all your eggs in one basket. I mean, the basic fundamentals.
It was a diverse economy over there. It was all on mining. Yeah, everything was about mining.
Oh, yeah, real diverse. Yeah. One-trick pony, and that pony didn't deliver. So, I feel sorry for those people who were coaxed into going into these particular locations, but it comes back to fundamentals. It didn't pass the lifestyle test, and if there's no jobs out there and the economy falters, guess what? You've got a ghost town.
You've got nothing.
You've got nothing. Yep. So comes back to fundamental investing, and that's a really important point. There was another stat that you had there too. Was it 1.5 trillion of lending?
About $1.5 trillion is mortgage.
So over 6.4 trillion in value.
25%. That's a pretty good loan to value ratio.
Yeah.
Right?
There's not a bad loan to value ratio there. And even if, let's say, because I love 60 Minutes. If you actually Google 60 Minutes and Steve Keen, I think in 2009 he came on and said that property prices are going to drop by 40% back in 2009. And I think there was another story in 2012 where he made the same prediction. So, look, media look for these types of sensational stories, and I'm disappointed in 60 Minutes, I'll be honest. They were a quality outfit many years ago. And so it's disappointing, I know, and but that's my personal opinion.
So it is Sunday night without 60 Minutes.
Well, that's I used to watch it religiously.
Every Sunday night I used to do the same thing.
So look, they're obviously trying to make a point, and that point was that gearing and the amount of servicing that lenders were lending. But I think they've missed the boat. APRA came in August, September last year, and they've adjusted that. And lenders are now tidying up those lending service ratios. So we're not, and how did we get through the GFC? Well, we didn't do stupid things like lend people who are unemployed money. But, like in America, you could get money, because what happens is your servicing calculator is based on a certain level of servicing. So depending on what income you had 30,000, you could borrow 600,000 in America. Just crazy stuff.
Non-recourse lending. Hand the keys back and walk away.
Jingle mail.
And go again.
And so whereas right through before the GFC and even with lower interest rates, we set our assessment rates at around 6.5. That was as low as they got. So even though interest rates came in lower, we didn't adjust that servicing ratio, and then that borrowing capacity didn't explode like it did in, let me guess, Ireland, Spain, the US, those types of places. So I give credit to the banking industry who set those policies back in the mid-2000s, because they made us get through the GFC. Yeah, the non-recourse is also important, but they've been sensible. They have been sensible, and APRA are sort of saying now we need to be even extra cautious, because when you have low interest rates, you naturally get asset appreciation. Look through history. Everywhere you go, if money's cheap, you'll get asset appreciation, because that's what stimulates the economy, and that's the job.
Consumer confidence.
That's the job of fiscal policy, and monetary policy. So government sets the fiscal, and the RBA sets the monetary policy, and that's what we're.
So we're okay then.
We're fine.
Steve, we're all right, mate.
Look, I think we're fine. Somewhere down the track, I think there may be blood on the streets in certain parts of Australia.
Yep.
And in certain suburbs and local government authorities. Moranbah is one of them, and I think we'll see some in the future as well.
But let's be realistic, though. I'm a miserable old git. I'm not that old, but I'm like a 70-year-old.
I'm
now.
older than you, mate.
I sort of sit there and complain about the world. But the people who are on the 60 Minutes show, pretty much, and I feel really sorry for them.
Yeah, we all do.
They've lost a lot of stuff, and they've got families and that, and it's absolutely horrible. But they're saying that the banks should be more responsible in working out whether or not they can borrow. Now, I don't want to go there. It's not my position to comment on whether or not it's the bank's responsibility to work out whether or not someone can afford to borrow something. They look at the numbers, and if they decide to give the money, they give the money. It's about expectations of your average Australian right now and wanting a lot more than what we used to in the past. So everyone now wants to be a property investor. Everyone wants to live in a brand new home. Everyone wants a brand new car. Everyone wants this and the other. Now, me personally, I rent where I live. I like where I live. It's a nice place. I can't afford to live there. Could I, if I wanted to afford to live there? Yeah, but I'd be so mortgaged up that I wouldn't be able to sleep in bed at night. And if anything went wrong, I'd be stuffed. Now, I'm happy with my relationship with debt, and I'm happy with where I sit right now, and it gives me capacity to do what I want to do, and I'm very comfortable with the result of it. But I don't drive around a fancy car. I don't go on too many fancy holidays. I live within my means. And I think that's a really important message for property investors, that you need to be able to be comfortable with your position and your state of play of your personal debt, and have capacity should times get tough. And times getting tough is you lose your job. Times getting tough is you might go down to one income. Times getting tough might be properties drop by 10% or rents drop by 10%. So it's all about having a buffer. And just to summarise and finish up with, that buffer is an important thing, isn't it, guys?
I think it's the key. I think always accounting for the worst case scenario is what will let you survive when that and if that does happen. So when we sit down with our clients, one of the very first questions we ask them is, where is your buffer and how much is it?
Yeah,
that's just a responsibility.
So you guys are property investors. You got a buffer?
Mine's over $100,000,
and that's just cash money sitting there in case you need it, or access to good liquidity. Yeah,
and look, we do. This is exactly what we do in our business. The cash flow modelling stuff is critical for us. So we have a minimum policy that you must have a minimum of 6 months trading cash flows. So if something was to happen in your household, we don't have to pull the gun quickly on a sale in a potential depressed market. So minimum of 6 months, but ideally couple of years. And we would explore heavily during that 6 month period, sort of explaining to the client, this is a tight servicing, this is a tight position, but that at least buys time, because money management is about time. It's about making sure that you can correct the situation in case things go wrong. What we saw with those examples was people rushing into so-called hotspots and mega areas. And a tip to all listeners, if it was that good, Steve and Phil would have been buying there. If it was that good, all smart investors would have been in there in a flash. And guess what? They weren't. And the reason why they weren't is because the fundamentals didn't stack up. So if it's too good to be true, or if the hype is around it too much, it's speculation. That's not investing in property, it's speculation.
Absolutely.
Thanks for tuning in, everyone. A little bit longer than normal, this podcast, but we covered some pretty key issues. Go to smartpropertyinvestment.com.au. Ben is going to chuck up a couple of things there.
Yeah, I'll put some
modelling.
models.
That'll be really good.
Up there.
Thanks for that. Thanks for joining us.
Pleasure.
Ben is the chairman of the Property Investment Professionals Australia, and Steve is also on the board. Go and check it out. This is an association which supports the property industry, really.
Yep.
So
we're non-for-profit.
Not-for-profit encourages people to use the right advice or look to advice and support as they build their property portfolio. And there's lots of stuff on their website, which is
www.pipa.asn.au.
Brilliant. Remember, Ben has got a very good podcast as well called The Property Couch. Check it out. It's on iTunes. Thank you very much for joining us.
Thanks, Phil.
And Steve, mate, thanks for coming back again.
Thank you.
It's really good. You can follow me on Twitter at Philip Tarrant. That's PHILLIP. Tarrant. Also check us out at smartpropertyinvestment.com.au and all the social stuff as well. Guys, keep the favourable reviews coming. We're tracking really well on iTunes. We really do appreciate it. Any questions that you've got as well, please send them through to me, editor at smartpropertyinvestment.com.au. Thanks for joining us. Bye.